Hi, everyone. Welcome to the Capital Raiser Show, Season 5, powered by the Family Office Club. I'm your new host, Weston Walker, and we interview only the best investment managers and entrepreneurs. Shout out to our sponsors, the Family Office Club, Capitalist Pro, and Invest Next. Today, we have two very special guests, kind of a double episode here, Matt Murphree and Lenore. Matt has around 26 years experience in the private lending, private equity space. And Eric is a very knowledgeable investor and invests in these types of projects. So welcome to the show, guys.
Thanks for having us.
Good to see you, man.
Of course.
Yep, thank you.
Yeah, so let's briefly go into each of your guys' backgrounds and then how you help people. Matt, and then Eric, what you look for in these types of investments.
Go ahead, Matt.
Yeah, well, for my business, we've been around 25 years in various forms, all within lending, always doing private money loans, bridge financing. Some people call it hard money, which I'm fine with that definition. Hard money is a term most people don't understand. It's essentially making loans that's based on the collateral, which is usually income generating properties. And so the valuation always in income producing properties is based on the revenue that the property generates. And we always play in that category, securing property where there's income or the income on the property is able to sustain the debt. And we're into that debt piece there for a variety of reasons. Always business purpose, usually in first position, sometimes in second position, always driven towards the cash flow of the property or the hard asset, being able to cover the cost of financing in the event of a default, which we've had virtually very few defaults over 25 years. And that's lending in hundreds of millions of dollars in private money loans, putting investors in loans. And then over the last 5 years, putting some of those investors in our EMAC mortgage fund, which is essentially a pool of loans, all secured. So that's basically who we are and what we've been doing. We're based out of Seal Beach, California. I also have an office in downtown Los Angeles, the office building behind me, which is relatively new. And we love California. We love the Western states. And, we love the business. That's why we do it. Scaling risk is a tricky venture. And, the underlying strategy for my fund and our lending is you never want to have to make a loan, to keep the lights on, so forth. So, we only make the loans that make sense. And that's the underlying point of performance and why we've had very few defaults over the decades.
Awesome. Yeah, Eric, go into why you like these types of investments and what else you invest in and what you really look for when you're investing in these types of projects.
Okay, let me give you just a real 10-second background on what I do or what I did.
Sure.
I came out of the investment banking world. I did early stage capital raises for biotech and technology companies in the 80s. And I worked for a division of Household International, which was also a joint venture between a couple big companies, including Goldman Sachs. Then I went on to be an airplane salesman for the Boeing company, and did that for a number of years. But anyway, my later career ended. Last 25 years has been spent with a very high net worth individual who happens to also be in Seal Beach, California, where Matt is. Sort of where Matt and I got together as friends at first, and then I started looking at some of the things he was doing, him and his wife Lorette, and I like the investment vehicle that he has, which is always secured by real estate, and not just some real estate, but cross collateralized, well secured by good real estate assets. So he's making hard money loans to the right clientele who is tired of dealing with banks that change covenant ratios and requirements every 6 months or every quarter, and need some stability in their financing. So I've been there. I've been in situations where I needed to get financing in quickly, and Matt's the kind of guy that can do it. Since I've retired about 5 years ago, I've looked at various investments, and Matt and I have always talked about doing business together. And this last year, we started doing it, and we're definitely heading in that direction. I have some people that I think will be very interested in achieving the kind of returns that Matt achieves with this low risk model. And I for one, I'll personally have skin in the game myself. So that's what I feel.
Yeah, Matt, go into the numbers behind these deals. If someone invests with you, you've been doing this for 26 years, right? Um, what can they expect? How often do they get paid? And what are the LTV of these deals and the markets you invest in?
In the mortgage pool, and just let me back up for a second. We provide the mortgage pool for some investors that are interested in being in a fund that's descriptive on the types of loans that they're in, and their risk is spread across a pool of loans. Those people in EMAC Mortgage Fund earned net 9.46% last year, which was our highest execution year in the last 5 years. We've never paid less than 8.25 in those 5 years, and that includes years, as you're aware, where interest rates were 2%. So
Yeah.
we've exceeded the market. There's always a trade-off between your rate and your risk. The risk index of the fund or the bucket of loans or the pool of loans is 41% debt to the collateral we have in the fund. So that's a very low risk index for this type of paper. Now, listen, EMAC also does the trust deed lending to bigger investors. In other words, we put investors on trust deeds on bigger deals. We love those as well. So I don't want to just limit myself to the people here in this group that may watch this. We have the fund, but we also provide higher end, bigger deals with higher returns. We funded a deal earlier in the year on a hotel in Detroit at a very low loan to value, as well as we had other assets. I think we did a $10 million private money loan against about 42 million in hard assets, and the investors netted about 16% on a 1 year deal on that. So we do the other deals. We can bring in the higher risk. I don't do those in the fund, but we do provide those options. Our investors get paid on a quarterly basis in the fund. So our minimum investment we're asking for is 100,000. So that's the minimum you can invest in the fund. You must be accredited, of course, and every quarter you're going to get that check from us.
Yeah, talk a little bit about how you reduce the failure rate for these loans.
We don't, the term failure rate, before I owned my own business 25 years ago, I was in the same business, but I was working for banking institutions, a Wall Street firm most recently, where we did a lot of lending on a national basis. We did a lot of numbers, and we learned early on in this game that the idea of scaling risk is very difficult. And regardless of who you talk to in this business, whether they're a regional or they're national, you have to be careful of how you build your business on the types of deals that you do. So understanding credit, understanding the types of deals, deals as simple as making a loan on a house for an ADU or rehab, all the way to bridge loans on a historic hotel. We've seen it all. And that's given us a flavor to knowing what deal to get into and what deal not to get into. And I would say the secret sauce behind why we don't have asset failure is knowing that point where you're making a loan to where the understanding between you and the borrower is that if they can't perform, that they understand and they're motivated by the fact that they know that they're going to lose a lot of equity. So in other words, everyone has to feel a certain tension of skin in the game. In the event of a borrower, we have to have enough equity where if they fail, we're going to get our money back. We're not have to worry about that. And they have to know that they have enough skin in the game where they have considerable amount of equity to lose. So it's all about betting on winners and knowing where to pick those deals.
Yeah, and you mentioned the 41% LTV, which is not a ton, especially in this market right now. If people were taking 85% LTV on some of these multifamily deals in 2021. Now they're losing all their money. So yeah, Eric, talk about what you look for in an operator. Obviously, Matt has a great fund going on here. um, what kind of qualities do you look for when you invest with a sponsor?
I definitely look for the quality of the underlying asset, and not only does Matt seek that specific asset, but he works with the borrower, but he also, I hate to say this, but he ties up the borrower. I mean, the borrower knows that if something goes bad, Matt's well secured. His investors aren't going to lose money, and that's the confidence I see in Matt. And you mentioned something about multifamily, and that's what I've been doing a lot of over the last 20 years. And multifamily loans have gotten to be so cumbersome and so hard to get that the banks have shied away from that, even though the assets are so strong because the vacancy rate has been so low, and the cash flow has been so strong. Um, I think that is changing right now, and that's what's scaring a lot of people is that there's some weakness in certain facets of the market, and multifamily might be one of them. And I know a lot of people don't want to hear that, but this is something I've been doing for I say 25 years. It's more like 35 years, and I've watched the cycles, and what Matt does is he insulates you against the cycle. In the worst case scenario, you're going to come out whole, and you're going to come out with a return that is very, very, in my book, satisfactory.
Sure. Yeah. So Eric, you've invested into different asset classes over the years. What are the best opportunities you're seeing in the market currently?
Um, I, I I never thought I would say this because I never liked commercial office space or anything like that, but I really like what some of the stuff that Matt's looking at that is in commercial buildings that he and another associate of his are looking at converting from commercial buildings to apartment buildings to hotels. Um, there's a lot of assets that have been under duress in the corporate arena that are now have some great potential, and there's value in that. Matt and I have been talking about this over the last several weeks, that might be the biggest opportunity. Multifamily, people are too proud of multifamily stuff right now. And well, they no up to this point they have been. Now you're starting to see a flood on the market. A lot of multifamily properties coming available. People can't get the financing, can't get insurance for one reason or another. And I always bought those assets when nobody else wanted them.
Mm.
And nobody has wanted these other assets to the extent that I've seen of late, and that's why I think there's an opportunity. I think a lot of the billionaire families are scratching their head, thinking, "What's the next opportunity?" And this might be the next opportunity. I've advised several very, very wealthy individuals that's the direction I would go, uh, and I think they're starting to see that makes some sense. I'm not a I'm not a rocket scientist at this. I just been doing it a long time, and Matt's been doing lending against real estate a very long time. He's forgot more than most people will ever know, and that's why I'm putting my confidence behind him.
Matt, do you have anything to add there?
Now, I would comment though, like what we've learned over the years in lending, going back to the subprime mortgage crisis, even the cycle that happened in the 1980s, with some of those loans that were made by the savings and loans. You got to watch out for the big trends, and I prefer to stay kind of niche oriented and look for the little pockets that are out there. When all of a sudden private money or private equity wants to go into one category, and it's been in multi-unit residential. You want to watch out for those ballooning markets, right? And, we've always looked for the deals that are just a little bit outside of the box, enough where the bank doesn't want to do them, and then our competitors that are out there doing private money aren't doing as well. A lot of my competitors have been jumping into, harder money multifamily. They're betting that the values are going to stay there. We're looking for other niches. I partnered with Pace last year on a loan that turned out to be a great yield and risk opportunity for us. We're looking for doing more of those. A lot of lenders are afraid of those loans. We're not, if those loans are done correctly. And also, um, what Eric has said, we're looking at certain markets, downtown Los Angeles and the historic repurposing of buildings, those numbers to pick up the price point that we're able to pick up some of these buildings, or we're seeing developers being able to pick up, that's a critical factor in how these assets are going to play out over the next 5, 7, 8, 10 years. We like those numbers. I mean, your cost per square foot in downtown Los Angeles is, less than half of what New York would be, for example, right now. There's certain opportunities that are just exceptional. So, we look for those types of opportunities, and not just we try not to run with the herd. We try to find those pockets, understand those markets, and call those shots. Always
Sure.
being covered with the real estate, the income. Yeah, the income is important on these properties.
Yeah, of course. Yeah, a lot of people are investing in the Sun Belt market, but you guys are really dialing in on California, which is sometimes where people stay away from, but that seems like, there's an opportunity there. Um, Talk a little bit more about California and why you guys invest there versus other markets.
Well, I think we invest here because we live here. What do you think, Eric?
Oh,
Yeah, it's not a bad place to live. I every time I leave for a period of time, I come back and it's it. I mean, the weather is just unreal. It always has been. But beyond that, I think there's still pockets. Matt and I happen to live in and around a place called Seal Beach, which we always said was basically Mayberry, and that's way before your time, Weston. But Andy Griffith's show in Mayberry was this small little town, and this is pretty much what Seal Beach is. And we like what the character that it has, and I don't like I don't like the big city, but I went into LA with Matt a couple weeks ago, and I see the opportunities there, and I see how much culture there is. And Matt does a lot of things that nobody knows about behind the scenes. He does his philanthropy and things like that. It's just he's where the rubber hits the road with everybody from the homeless to multi millionaires. It's a neat place to be. I think that might be true in a lot of cities, but California is still where it's at. I think that the assets, when the world does come crashing down, the assets don't come crashing down as hard. And I think people, there might be an exodus out of California right now by some, but there's still a lot of opportunity for a lot of us. So that's why I'm hanging in there with California. But I also have dual citizenship, so I might be in Italy a couple months a year. I don't know.
nice.
Western California for us has been like this, and we had an office in San Francisco for 10 years. San Francisco is my hometown, but in California, you have this anything within 10 to 15 the beach has been just golden, and there's been very little downturn over the decades, maybe even over the century. Like very few. And I think picking the right markets, right? And Eric and I live near the ocean. Anything within 10, 15 miles of the beach has been very, very stable. And that's really been kind of the backbone of where we've done a lot of our loans. And so I would attest to that. Not all of California has been great. Look, I went into a family office earlier this year. I was asked by the administrator to come in and look at their portfolio, about 150 million in loans, and they were sitting at a 12% default rate. No, excuse me,
Hmm.
foreclosure rate on fix
Wow.
and flips that they had done over the last 24 months. And so they were doing a lot of stuff that were Inland Empire in other markets, and their partners were stretching deals, and yeah, so California is not a not a bowl of cherries. You got to know where the market is. And I'll attest for the coastal markets and then opportunity zones. In this case, right now, we're really looking at downtown Los Angeles, which, like all major cities in the United States, were devastated by COVID. Um, but we're seeing a lot of opportunity. We start compounding the historical tax credit you get on a federal level, the Mills Act, which is a California state tax credit, and then opportunity zone tax credits, and then some other local stuff that's coming up. That stuff adds up, and it really turns a deal that you may not be in the best neighborhood where you want to be, but the numbers make a lot of sense, and that's important. And it's also important that we have transitioning neighborhoods that are getting better. The future of California, and actually the future of every Western state, has got to be focused on urban development. We've all got these problems, and I think we're at the end of the rope in terms of dealing with them the way we have been dealing with them. I think that investors mixed with some government activity is going to increase the investments in these communities, and it's important. It's unacceptable what's been happening with the homeless, for example. I mean, if you go down, and I know it's in every city, whether it's Phoenix, Salt Lake City has their own problems. And obviously the big cities in California have these problems. That's only going to bring opportunities moving forward.
Sure. Yeah. Sometimes. Go ahead.
No, I was going to say I'd only add one thing. Matt and I kind of disagree about this a little bit, but during the Great Recession, 2009, I bought a coastal property, a residential property to live in, and the asking price was $1.7 million, and I paid $1.05 million for it. In 2022, I bought a property for $2 million, and I think there is some residential correction that's potential. The only anomaly there is I think Seal Beach. I don't think Seal Beach ever goes down. But the outer lying areas, Huntington Beach, Long Beach, all San Pedro, that area up there. There's going to be a correction. We had a 15-year cycle in residential real estate, and I think that's coming. But I think again, Matt's investments are in the right places with thought out scenarios that could happen, and that's the difference. There's some overbought areas in Southern California that need to be there needs to be a correction. But Matt might not think that's going to happen. I do, but
you know what? No, we should. I appreciate that, Eric. We shifted 18 months ago away from the flips, and we got more into commercial deals that made sense, often where we had additional collateral. It's pretty common on the types of deals we do that not only do I have a commercial property, but I also have a house. We're driven towards collateral. We will make exceptions in other areas. We want to make sure we're covered with that. And so, no, I think intuitively we've known, and what Eric, I think, is referencing to is moving forward, if we're going to have some softness, there may be in certain markets. The national data doesn't say that. I think the big topic that some people are talking about and a lot of people are not talking about is the debt, the national debt. And I think that what that spells out is one main factor is that the only way you get through managing or mitigating this sort of debt is going to be to outgrow it, which means there's going to be more inflation, right? So, can certain markets dip? Yeah, of course. Maybe some markets that Eric's referencing to that maybe were ballooned up over the low interest rates of COVID. That's a real good possibility. But overall, in general, I think real estate, looking mid and long term, like 10, 15, 20 years, if we're going to tackle this federal debt problem, $36 trillion, we're going to have to grow ourselves out of it. So that means higher values in all asset classes. When's that going to happen? I don't know. That's
interesting. Yeah, so it seems like your investments are insulated from any downturns because you're lending, because you have the conservative LTV and other factors. Matt, talk a little bit about the fees that you charge with your fund and what investors can expect.
Yeah, we charged 1.5% servicing fee. We have a preferred split. I'm getting ready to modify that. Um, and we're looking at a 80-20 split with the investors, and that's all we need to really to get out of this to be satisfied. I also collect fees. I also share in some of the points that we charge, so it's not all just rate to the investors. We're looking at it both ways. Um, and we're always happy when some of our investors help us grow on the capital side, which is why we're here. We're looking to grow this fund. My internal partners, the more capital that they provide, the more of an incentive that we actually create within the fund for that as well. So I feel as far as how we're compared to our competitors, I think that I'm actually my fund is charging less than the average out there. We're getting more, and I have a lower risk index. I hope I can sustain these numbers forever. But often when you have to grow, you're going to have to trade off somewhere. If it's a volume swap out for maybe some higher LTV, sometimes we have to do that. But that's where we've been. We've held back over the last 5 years. I was concerned during COVID with low interest rates, what was going to happen. Going into this year, we felt stronger knowing we had some footing and moving into a market, at least where if we're heading into recession, great. I'd rather be there than not know where we are. And that's where we've been during COVID with all the flooding of the markets with the cash, the moves that the Fed felt they had to make. I feel a lot better today than I did 3 years ago, for example. I hope I answered
That's
your question.
interesting. Yeah, of course. And how long are investors locked in? And is there a liquidity structure in the fund?
We asked for a 2-year period, and we've never had an investor leave our fund. So can I
Oh,
raise to exit investor? Yeah, we can do that. No one's ever had to or wanted to leave so far. I do have a structure set up for that, and I am prepared on the terms that we have negotiated, and I plan to move forward to maintain the position I currently have, which is I could basically, within 60, 90 days, exit anybody in this fund.
got it. So you've been doing this for 26 years. You've never had a single person exit your fund?
Now,
Wow,
the
that's
fund has been
incredible.
around 5 years. The
Five
fund
years,
has been
got it.
around 5 years. Yeah. Prior
Okay.
to that, we were always doing the trusted investing, putting an investor in individual deals. So in the fund, we never had an exit.
Yeah, so you're more diversified in the
What
fund. You have multiple properties.
at 9.46%, why would you?
It's true. Yeah, Matt, what's your vision going forward? Are you going to keep doing the same business plan, or do you plan on expanding to, different markets or different asset classes?
We could always now we're going to stick with what we know, the real estate. I mean, that's that simple as that, right? Yes, I like other markets. We have experience in other markets. You can get higher yields in some of these other markets. Um, it's once again, I want to get back to this. We don't ever want to be in a position that you have to do a loan for your business model in this space, right? So we own a real estate company. We have a lending company, mortgage banking, mortgage lender company, and then we have the private money, and they all kind of dovetail to one another and feed each other. And I want to grow this. I do want to scale this, but I want to scale it at a responsible rate. I don't need to do. We certainly don't need to do every deal out there. And I think the secret sauce in my fund and our deal and how we deal with people, whether it's a family office we're doing a deal with or my fund, is we don't ever want to be in a position where we have to do a deal. That's where the mistakes are made historically in this business and in banking. You want to go back and talk about subprime lending? You had Wall Street entities having to do securities, which led to bankers having to do deals. They had to brokers were putting together worse and worse quality loan packages from the consumer. So there's a trickle down to what motivates you on doing a transaction. And for us, it's just going to be about doing the right deals.
For sure.
Wes,
Yeah, and Eric, you were going to help Matt scale his business possibly, and you've invested with him, and you seems like you have some connections. Maybe you can help him scale. What's your plan there?
yeah, I think some of my contacts might be a little antiquated, but they also don't understand the security feature that goes with Matt's investments, and I think that can change a lot of people's minds if they start to understand this. You mentioned a couple things. Matt mentioned subprime, and on the commercial side, subprime in the 80s was a thing called a leverage buyout, LBO. I was in the midst of that. I did leverage buyouts on all these huge grocery store companies and trucking companies and everything else. And when people were taking companies private for these crazy multiples with the hopes of having earn their way out of this huge debt, and sometimes it just didn't happen. And I think Matt might correct me if I'm wrong, but I think subprime was kind of a little bit that way in real estate. And the debt was just so exorbitant, and we got ourselves in trouble as an economy. And I think what we can do, what Matt and I can do, is bring people to the table that haven't thought about a secured investment that can earn 10%. Take some money out of treasuries and things like that, and have something nearly as secure, earning twice the return. And that's kind of how I look at it. And I think I can convince some of my people to go in that direction. Some of them, I'm amazed at Beverly Hills how many family office executives were looking for places to put money that they hadn't seen before. And that's when I told Matt, instead of raising 50 million, we should be thinking about 150 million, 200 million, 500 million. But Matt's conservative. He doesn't want to overextend himself, and I get it. I guess I just turned 59 last week, and I'm a little bit more cautious than I used to be. Yet I kind of know a good thing when I see it, and that's why I have confidence in Matt. Not because he's my friend or anything. He's not. He's not. He's an associate that has become my friend because we have so much in common. And it's just I look forward to what I think we can do. A lot of great work out there right now, and make a lot of people a lot of money.
Absolutely. Yeah. So one last question for you guys: if someone wants to invest or partner with Matt or possibly Eric, how can they get in touch with you?
Go ahead, Matt.
Yeah, I mean, emaclending.com is my website. That's emaclending.com. You see up here on my thing up here, emac. So emaclending.com is a great place to start with us because it gives our bio, our story, the history of our company, and kind of the character of who you're dealing with. So the credibility is important. Has been our main stickler as business owners over the decades. And so, a lot of people in our category come and go. We've been here. I'm a generational lender. I was inspired by people, my family, to be in this business. We love it. We love people. We love the people. We love the transactions we do. And that's about representing, the borrower and also representing the investor. So that's our passion. And you can find it there. So it's emaclending.com is the best place to find us.
Awesome. And we'll put that in the
Where do they find you, Eric?
below.
Where are they going to find you, Eric?
I got a new website that's coming out in the next week or so. It's just ericlenore.com. I didn't know what else to do. I've got a former associate that was my legal partner that's now a developer of websites and all sorts of different things. But she's finishing up my stuff, and you'd be able to get. But I would encourage people to go through Matt's website, and they could get me through there. Get my contact information from Matt as well. But
if you want Eric, I'll track him down for you.
Yeah.
Awesome. Well, thanks for coming on, guys. Really appreciate it.
All right, man. And good luck.
Thank you, Weston.
How far are you away from graduation?
Man, I'm walking in graduation in about a month. It's crazy.
Oh, wow.
It's gone. I'm graduating as a sophomore this year. Really excited for that.
That's true.
Congratulations, and that's huge.
Yeah, thank you.
It's impressive.
Very impressive.
Thanks,
cool.
Weston.
Thanks again, guys.
Okay, we'll talk to you.
Thank you.
All right.
Okay, bye-bye.